Today we will be talking about Expedia Group. For those who don't know what Expedia is and what they do, they're an online travel company which engages in the provision of travel products and services. So they basically help you book um, a house or a hotel or for your travels. And they own 200 different portfolio brands, including their own brand Expedia, Hotels.com, Verbo, Orbitz, etc. And they own Verbal, which is an Airbnb competitor, and Expedia is a competitor with Booking. They have two different giants competing with them, including Booking, Airbnb, and the legacy giants like Hilton and Marriott. Now, you might be asking, why are we looking at the stock today? Stock don't go up, which means it's a bad investment, right? No, we are value investors here. We look for things like PE, free cash flow yield, earnings yield. And by the free cash flow yield, it's a juicy 14% yield, which means they can literally put a 14% dividend on the stock and they don't have to grow at all. They can just cut their R&D expense, they can cut the marketing expense to a low, and they can give a 14% dividend to all the shareholders. And I like to compare the free cash flow yield with the 10-year bond. And the 10-year bond is at 5%. And that's lower than 14%, and it's in line with the earnings yield. Now, usually, with yields as this high, there's always a caveat. The caveat here is it's not the best business in its industry. Let's look at the market share, shall we? The market share of the online booking app industry, Booking Holdings, which we will be covering in this video, owns 34%. Airbnb owns 23%. I'm sure all of you know what Airbnb is. And Expedia owns only 11%. And just because a company's smaller does not mean it's worse than other companies. But if you look at the net income margin comparison, let's look at this growth rate here. Booking and Airbnb are sort of in line, 20%. But Expedia is just straggling behind with only a margin of around 10%. It's not good. It doesn't necessarily show business competency. But I will make an argument here. I go by this philosophy that just because a business is not the best business in this industry doesn't mean it's a bad investment. A good business doesn't mean it's always a good investment. So a lot of you are going to hate me for this, and a lot of Warren Buffett fans are going to say, "Hey, that's not what Warren Buffett says," but this is what I stand by, and this is what has worked for me in the past few years as an investor. Now let's deep dive into their financials, shall we, or more of their metrics. And just a quick plug, the website I'm using is Stock Unlock. I don't own this. I'm not affiliated. It's just a great website. And I am developing a website behind the scenes, but that's going to take some while to come out. By diluted shares outstanding, so by diluted shares, share buybacks. Um, the more a company buys back shares, the bigger piece of a pie that the shareholder gets. In the CAGR terms, Booking has reduced it by -3%, but Expedia has gone up. Now, management was different in the past 10 years. There's only a recent CEO. He took power in 2020. I actually believe in the CEO. I think he can turn things around. Free cash flow, again, Booking compounded at 13%, 8%. Return on capital grew by 1%, decreased. But the returns on capital are actually pretty high for Booking, 41% as their high, and the latest is 41%, and 12% capital employed is not good. However, I think this is a one-off thing. Let's not worry about it. At a high, Booking had 217%. This past quarter, they had 50% Expedia, which is pretty good. And revenue has compounded at 13%. But if you look at the revenue growth rates in the past few years for Booking, it's been much higher at 20 to 30%. But Expedia only grew 6% in this past quarter. Not only that, let's look at their earnings report. Let me make you make this clear. It's grew 6%. Now, some of you P nuts, you might be saying, hey, 18 PE for a 6% growth rate. I don't look at that. I don't care about this company anymore. Uh, I like free cash flow more because free cash flow shows more of the earnings power than the business's PE. I like to use PE sometimes, but in this case, I think the free cash flow just shows everything. I think it's a dirt cheap business, and not only that, the management actually thinks it's undervalued. They repurchased $1.2 billion year to date, but the market cap here is trading at 16 billion. Let's do a quick math for those of you who don't have a calculator. 1.2 divided by 16.13, that's 7.4% of the market cap. On average, uh, every company in the S&P does 2% in buybacks. 7% in a year is pretty nice. Pretty nice deal. And they have enough free cash flow to cover that 7% buyback. And they reiterated your full year guidance. Not only that, I think there's an undervalued businesses or two undervalued businesses in Expedia. One is their business to business revenue, which increased by 32% year to date. 32%. Not only that, um, if you look at Value Investors Club, for those of you who don't know, Joel Greenblatt's created this website, fantastic website. The full thesis is behind here. It's written in 2021. It still has some worth. You can read that on your own time. But what I want to talk about is someone pointed this out. If you look at the 2019 estimated revenue for Verbo, which is again Airbnb's competitor, they had $2.1 billion in revenue, 18% take rate, 50% growth in 3 years average. 2023, 10% below consensus growth of Airbnb, 25% operating margin. These numbers look great, but when you assign a 16 average market multiple, you get $74 a share. That's 68% of the market cap. But that would be higher now because the business's fundamentals have improved. Verbo, Expedia, their B2B business, and the share has actually gone down. Now, I like to find businesses where the fundamentals are really improving, but the stock price is down. This is one of those asymmetric risk to reward opportunities. And for those of you who don't know, the stock dropped 17% on its earnings date. 17. But they delivered good results. They didn't meet analyst expectations, but we don't care about analyst expectations here. We take them with a grain of salt. Now, you might be asking, how much is this business worth? Let's use Stock Unlock's DCF tool. We're going to use free cash flow to value it because I think free cash flow is a more accurate number to value this business by. Just because the amount of free cash flow it generates it makes the business look dirt cheap. Now, Stock Unlock, it does autofill, so it gave the metric it's done in the past 5 years. So it's done 15% in free cash flow, reduced shares outstanding by 0.08% or 18%. A price to free cash flow ratio of 7, which is in the past 5 years, that's pretty low, below market average, despite it being a good business. A discount rate of 10%, which is always sane, and this is the most recent metric override. Now, by average growth rates in the past 5 years, you get a CAGR of 16%, which is well above the market average of 10. Now, just because you get this fancy number over here doesn't mean you go out and buy. You obviously got to do more research. Don't use my video as your main thesis to buy the stock. You got to do your own research. But let's say they don't reach any of these numbers. They fall off. They don't do good. Let's cut this off to 7% growth rate. But even though it would return a 7.96, I still do believe a price to free cash flow 7 is just low. I think we should assign a market multiple, which is average, around 15. This is a 25% CAGR. The 10% discount rate, 7% growth, barely any shares outstanding growth. But let's say they're able to return capital. Let's say 15%, 15 price to free cash flow is good. Let's say they want to return an average multiple of 2 to shareholders. Then you get a 27% CAGR. And just so you know, if you've seen the thumbnail, Michael Burry bought the stock. Even though he's sort of a short-term trader, I still do believe what he sees in the stock is even if a recession hits, they can still use the free cash flow from their business to return capital to the shareholders. I still do think you need to do more research. If you guys like this video, and I'll look through this video again, if I do believe I haven't put enough info and you guys like this video, maybe might make a part two, diving more into the business and its competitors, not just Booking, but Airbnb. But for now, that is all. If you have any questions, comments, or concerns, please type down below. Any feedback is appreciated. This is my first video. And in value search in this YouTube channel, we want to find or search for companies that are trading below their intrinsic value. We are value investors here. And of course, if you have any stocks you want me to look at, I'll take a look and then I might make a video of it. Other than that, have a good day, guys.